Okay, it's Luke Fannin here. How you doing? We looked at risk questions in class and we're just looking at these risk questions again. Here was the first one, Donald Company. I just said describe 5 audit risks. We haven't really done enough to start looking at auditor response. I'm not going to spend any time on this because I've already done a video, but I just want to jump to the answer. And the big thing I want you to do is obviously the answer is part A and 1 and 2. But for part B, the answer has 5 audit risks, and then it's easy to see the auditor response for each one from the way the answer is laid out. So here is the audit risk. Part B, audit risk, audit response. Now you don't have to do it in a table like this, but here is the first risk. And then here is the response. So you could do this across the page, the first one, and then do the response after. You can do them particularly when they're, even if there was part B1 and 2, or even if it asked them separate, you could still do them together. And when you're looking at these answers, just see or note how each of the risks is linked back to the accounts. Errors in relation to completeness of income in the accounts. Not removed from sales, tickets to be refunded, linked back to the account. So that's the big thing. And then the audit response are all fairly common sense. You could talk about them in terms of tests of control or audit or substantive procedures. Verify a sample, substantive procedure. Most of these are substantive procedures you're trying to verify items. That's that question. I also wanted you to look at this question, Bridgford products. And I was a bit unfair in that I just said identify the risks. So what I asked you was not what it asks, because it asks for planning the work and then describe matters you'll consider in planning and further action you'll consider. So I just from an initial viewpoint of this, I just want you to identify the audit risks that you see. So if I go down to the answer, the ultimate answer, which is down here. Here's part A. And then here is B. Quite long. It's not really discussing it in terms of risks. It's saying what areas are looking at. Further bad debts and claims. So it is talking about in risk, but it's not really highlighting as much as maybe it could have. And that's what I wanted ye to concentrate on first in relation to this. You know, and here it talks a bit, absence of director means certain controls may have lapsed. You know, with the accounts prepared on time, problems in the accounts. But it's not really shouting out the risks in the answer. Of course, I just asked you to discuss the risks or highlight the risks. So in the first one, the accounts look like they're going to end up with a big profit, much bigger than last year, and a small loss. You know, and it's changed a lot from last year. So either there's a risk of overtrading, or possibly there are errors in the accounts. You know, you'd have to question management about what the change from this year to last year. If you're going to talk about overtrading, you would need to frame your risk in terms of overtrading could lead to a liquidation, going concern, issue material uncertainty about a going concern which needs to be disclosed in the accounts, or the incorrect going concern assumption will be used in the accounts. That's the risk. It talks about inventory here, and really the risk here is that closing inventory in the accounts would be incorrect because, you know, incorrect valuation would be used for it. Because the inventory count at year end is a really important internal control. So as auditor, you'd need to check to see how reliable the new inventory system is, but that's slightly different. The audit risk then in this, it says about legal claims. Anytime you see possible legal claims, you're looking at provisions. Should there be provisions recorded in the accounts? Are they missing? Are there contingent liabilities? Disclosures in the notes in the accounts? customers refusing to pay for products, are receivables too high for those customers? Should they be written off? And it's the same issue here, really. Extended credit. So you're talking about a bad debt provision, perhaps, receivables being overstated in the accounts. And then the risk with the dismissal and the new financial director not coming in, risk of errors due to, it's a control risk, the financial director. The financial director would supervise the chief accountant. Would help with segregation of some key controls, perhaps. So there's more chance of errors in the accounts. And also, anytime you see something about staff being dismissed, particularly key staff, you'd ask the questions auditor, what happened, why, was there a fraud, and then could this, fraud affect the accounts? So it didn't really ask for the risks in this, but I was just highlighting the risks here for you, just to get a handle on audit risk. So thanks for watching.